Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Friday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Dennis Dick. Got a lot to discuss on our show. So I guess we got the answer to the question yesterday, who's going to rule the market yesterday? Will it be the Apple news or the biotech news? We got that. It was Apple. They ruled the market, and we actually saw a lot of weakness throughout the day in the healthcare stocks. So we're going to talk about that. We're going to talk about GameStop, reportedly, that has apparently a couple private equity offers on the table. We're going to talk about Ford getting a tender offer. The Airliners getting a hit yesterday on some Delta Airlines guidance. We got some ratings to discuss. And our guest today, 8:35, will be joined by John Inch, Senior Analyst at Gordon Haskett. Dennis, I'll bring you right in here. How's it going this morning?
Busy. It's obviously a big bounce back morning here for the market. What do we say the catalyst is here for this? Like, what are we thinking? Because obviously, you got a rally here and everything, but it's just like a dead cat bounce here. Do we have a catalyst? Was something said that really drove us here overnight? Because it's a pretty good rally after a pretty big down day.
All I'm really seeing, Powell's supposed to speak today, and of course, I didn't mention the jobs number. We have that in about a half hour. I haven't seen an overnight cap.
Nice bounce back, but I think it's nothing more than a dead cat bounce. So I'm not getting excited here. I actually was lightening up in my portfolio yesterday. I did sell my Celgene, booked that gain, obviously. I sold it near the open. I tried to get out on the open. I was a little bit too high. I ended up getting out in I think 85.90 or something like that. So happy I did. It continued to fall. And you're in a bear market when you've got a stock that gets taken over for equivalent of $104 and it's at $80 the next day. You're in a bear market when, and obviously that's all because Bristol Myers fell so much yesterday. But we've seen the acquirers get hit, but that acquirer got hit hard, down 15%. So it's just a difficult market. Even when you get a takeover like that, you think, oh yeah, I'm going to, make big money on this. And really Celgene shareholders, if you held it, and just kept holding. The stock closed at 66. 104 is the takeout price. It's at 80. You only got 14 points.
I should add,
which is pretty sad considering that the premium was much higher, but it all came out of the Bristol Myers stock. So it's a tough market to make money in. And a great point was made yesterday by Dan Nathan on CNBC. And we don't talk, the CNBC Fast Money guys that many times, but I completely agree with what he said. I don't know if anybody watches Fast Money. I think a few people probably do. But he said this is the worst market, because some of the other commentators on CNBC were saying, I think this could get taken out, or I think this could get taken out. And he said, this is the worst market to be buying stocks, hoping for a takeout in. And I completely agree with that. Here, you actually got lucky. I got lucky. I had Celgene in the portfolio. It gets taken over, and you only get a third of what it gets taken over for, because really, from 66 to 102 or 104, you're talking about, 36 points or 37 points you should get, and you get 14. So obviously I sold 85, so I got a little bit more than the average bear, but if you're still holding on to it now, you're only getting and that's just saying, what if you had Bristol Myers is what Dan Nathan was saying, and you get crushed on it. So just coming in here and randomly buying stocks because you think it might get taken over is the worst idea, because you're in a bear market here right now, and stocks are getting hit across the board. And yes, there's going to be some takeovers. There always is M&A action. Maybe there'll be a little bit more because stocks are really on the cheap. But have a reason more than just going in there. If you're going to buy a stock, like the fundamentals, like the long-term story, don't bank on a takeover, because this could get a lot uglier before it gets pretty. We just look, Apple obviously was the catalyst yesterday to drive the entire market down. You get a nice bounce here today, but every one of these stock charts looks awful, really, when you look at them all. Apple, there's no reason it needs to bottom at 142. I own Apple, my long-term portfolio. Stick in your retirement account for the next 25 years, you're probably okay. You're sticking this thing in for the next 25 days? Who knows? This thing could be 130, 120. You don't know. It just went from 220 down to 142. Why does 142 have to be the bottom? closed on the lows yesterday, bouncing with the overall market here, but I don't see any type of a bottoming formation here. It took out those lows from 3 days ago, a 146, 146.72. That's from the Christmas Eve and the Christmas and Boxing Day, as we call it in Canada, day after Christmas lows. So you're making new lows. And I say when you're a trader, when stock's making new low, you got to go. So, and there was a lot of trades. I tried a couple yesterday, a couple little, I thought, okay, well, maybe some of these bottoms are going to hold. Nothing holds. So again, I have no longs in my swing trading portfolio. I'm hedged on my day trading portfolio. I was actually a little bit short today coming in, which isn't good news, but I'm not that concerned about those because this market seems to give back quicker than it continues to rise. So day to day is difficult to predict. But this market's still in a bear market. Don't let the commentators on CNBC tell you otherwise.
I should mention it. I didn't mention this at the top of the show. As far as you asked for about an overnight catalyst. The U.S. and China are going to have trade talks on the 7th and 8th, but it's at it's at a lower level. I personally, I'm just skeptical until I hear anything out of.
We're gonna get a deal. We're gonna get it.
Yes.
And it's in Trump's best interest to get us. This is going to be the pop. You're going to get another pop here, and I think you're going to get a deal in the next week or two. And you're going to get a nice pop from that. I think it's going to be another opportunity to sell. It's been sell the rip continuously here. That 1,000-point rally, obviously, that I was calling for, and obviously happened that day on the Dow. And I also said on the show is I think that's going to be the selling opportunity. Well, I hung up there for a day or two. But again, it looks like it is the selling opportunity there because here we are. We've given back a portion of already. Yes, we're popping back up. So yes, actually we're right where we were after the 1,000-point Dow rally here. So the lows are still intact for the SPY, but there's so many other stocks making new lows. And you just look even the action in the semiconductors. I mean, look at what they were doing. So you can look to Western Digital here. Had a huge day 2 days ago. Huge day. So we're talking Monday, or would have been the 2nd. Stock was trading up like 8-9%. Applied Materials, huge day. One bad headline from Apple, and all that's gone instantly. So it's so difficult to come in here and say, okay, yeah, everything's cheap. I'm just going to load up my trading portfolio because all these stocks are going to come back. Again, if you're a long-term investor, maybe it's a different story. If you have a lot of cash, sure, nibble here. But don't go all in because there's no way anybody's going to call this bottom. I'm not going to try to call it. I think I don't think anybody can actually call the bottom because if they do, it's just going to be luck. And
speaking of Apple, here's a great stat I saw courtesy of Seeking Alpha. So they've fallen about 39% since October 3rd, and that fall in terms of market cap is greater than the total value of 496 of the 500 companies in the S&P. So there are only 3 companies whose total market cap is not greater than the amount Apple has fallen by in the last 3 months. That is crazy.
Incredible fall. So, I wouldn't have thought that Apple, when we were looking at 2 months ago at 220, would even have a chance. And this goes to show you one other strategy too. When you're writing naked puts, there's probably people who are saying, okay, Apple's at 220. I'll write the January, 3 months out 180s. I know I'm safe there. I'll get $1 for that. Well, you know what? It's 142. That I'd imagine, I don't know what the premiums were back in October, but I'd imagine on the 180, 40 points out of the money before we started the fall, you're probably not getting more than $1 or $2 for that 180. That 180 put is now costing you $38. So if you want to own the stock, sure. There's a strategy maybe there to write puts. But otherwise, do like Nick does it and buy a lower one to cover yourself. Because Nick will usually write the 180 and then buy the 175. He takes in a lot less premium that way because he doesn't get the whole thing. But at least he's protected in the event of a downturn there. And I know that, that's what Nick talks about on the show a lot. So you got to be very, very cautious with just flat out naked put writing. And especially in this market too. I saw a lot of people yesterday saying they're writing the 130s in Apple because, and that's fine. If you want to own Apple stock, go ahead, write the 130s, but just know that, don't go writing more than you can chew on because people will go in there as like, oh, I'm only getting $1 or $2. I might as well write 10 contracts. Can you afford 1,000 shares of Apple? Because that's what the equivalent is. So don't bite off more than you can chew when you're doing your naked put writing. I'm not really a fan of it altogether. I know Nick does really well with it, but he's doing with spreads and doing different things. The reason I'm not really a fan is because overall, it works very well in that market. It works very well in a sideways market. It doesn't work very well in a down market because what you're doing when you're obviously just flat out just writing naked puts is you can say, yeah, I would buy it down there anyways. But you're also, limiting, you're not participating in the upside move as much as you could if you flat out bought the stock. I mean, let's say you buy the 130 puts, and maybe we should just go grab do you have the premiums in front of you, Spencer?
No, I don't.
I know Joel keeps this.
No, I don't.
But I can just look quickly. Let's just look for hypothetically and just set this straight up. And this is why I don't write naked puts. But I'm not saying you can't do it. I think Nick Shaheen does a great job with it. I just like the way he does it better because he protects himself. But okay, so let's go look at the options chain. So on the 130s on Apple, because you saw a lot of people saying, how can you go wrong? Tell you how you can go wrong. Just bear with me here. We don't talk options a lot on the show. I used to trade a lot of options. So just because I don't talk it doesn't mean I don't know much about it. I used to trade a ton of options 7-8 years ago. I'm more of an equities guy now, though, so I don't do it as much. Let's just say you're going to go out to the June. So you're going to get a nice premium probably. So on the 130 puts, you're going to get yourself $7. Not bad. But, let's just say hypothetically here, okay, so now you're in at 122. It's pretty good. It's pretty good. If you want to own the stock, it's good. But if Apple went to $100 or $90, so let's just say you write the 130 instead of buying the stock. So instead of buying the stock at 144, or 142 yesterday, you decide to write the 130 put for $8. So the most you're going to make on that is $8. That's it. That's the most you can make. If Apple rallies to $180, you make $8. If you bought the stock yesterday and Apple rallies to $180, you make 30. Obviously, at 20. One of my math is $38. So you're making a hell of a lot more money. So you limit your upside, but you don't completely limit your downside. Yes, you get it at a cheaper price, but you're participating with it if this thing gets crushed. And that's what would have happened to people back in November, probably, if they were writing the 200s on Apple, at the 200 put saying, I'll own it anyways. I'm going to get $6 for this. I'll write this 2 months out and get $5 or $6. Well, now they're down $50 on that. So that put rate doesn't look nearly as good. It probably makes more sense of these prices because is Apple going back to $100? I don't think it's going that low, so it starts to make more sense. But again, the one problem is when you're just writing puts, and that's the way you're going to do all your investing, is you limit your upside and you don't limit your downside. Yes, you reduce your cost of it. Yes, you're getting an Apple if you're writing the 130s for $8, you're getting it at 122, which is a great price, but you're not participating like a long would participate. So that's just my style. I like to. It's all risk reward for me. Again, Nick does it in a different way. And if you're listening here, I'm not poo-pooing your strategy because I know you often, will write the 130 but buy the 125. So that's the way you protect yourself. So he's making the risk reward scenario better by buying the downside put to protect himself. When you're just flat out buying puts or selling puts and the market really goes south like it did in November and December, you can get hurt pretty bad.
Writing naked puts can be very dangerous.
A lot more dangerous than people, think.
Yes.
Think, oh, worst case scenario, I own the stock. Well, worst case scenario for the people who were rating 200s on Apple in November is they own the stock now, and it's $144.
Yep. Great point, Dennis. It's all about not just buying power, but risk reward as well. So let's move on to some other stuff today. Some news of this morning. I want to talk about this GameStop headline here. This is an interesting one. So GameStop is up. If you've seen that headline or looked at that chart today, it's up. What is it? Last I saw it was around $14.50 here. So the news is this is from a report in the Wall Street Journal. Buried about 6-7 paragraphs into this story on GameStop. There's a little note here that says some private equity firms are circling. Sycamore and Apollo are bidding for the company. A deal could be announced by mid-February, according to a person familiar with the matter. Now, the fact that is buried so far into this report tells me that tidbit right there was not. They weren't confident enough in that to make that the story, the lead of the story, or make that put that in the headline. It's just sort of you have to actually read the story to get that little nugget. So I don't know how credible. I mean, it is the Wall Street Journal. Obviously, they're great, but I don't know how credible that scooplet is.
Right. And it's a great point you're making here. And the market, the reason you're making this point is because the market is really rallying GameStop because this was the fourth line down. And, there's a potential buyer in the market. Again, if you're coming here and buying stocks because you think they might get taken out, yes, they might. But, GameStop has had declining sales. We know everything's getting done online. They don't need these physical stores. I don't like the business as a whole. So could it get bought out for $18? Sure, it might happen. But I think that's the only way out. I think otherwise the stock is a lot lower. So here it is. It's a gift this morning. It's up $1.53, trading at $14.50. Could it go up to 15? Yeah, 15 is kind of where, I think the resistance level is. If I was long this thing, I would be ringing the register and just saying thank you very much for the gift. I mean, again, look at what happened to Celgene. Look what happened to Celgene. It ended up being up only like 14 points. It ended up being up like 18% yesterday after getting taken out for over 30%. So even if this thing gets taken, it gets a buyout for 18, it's not going to trade there right away. It might trade at 17 or 16 and a half. And what if the buyout's only 16? It might not trade much higher than it is right now. So buy stocks for your long-term portfolio if you like the company fundamentals. Don't buy them because Wall Street Journal says, oh, there might be somebody going to make a bid. That's the time to sell. Sell on rumors, and in this market, sell on the rips is just working. $14.50. I'm not shorting it because there's potential, buyer on the table. That would really suck to get taken over on you. But I'm not buying it up here at $14.50 because WSJ says there's somebody sniffing around.
Exactly. And, it's up about 11% this morning here. The article was more about the company's struggles and they're exploring strategic alternatives and less about, someone could take them out in 2 weeks, right? Or 4 weeks. So, So this seems like a gift here this morning.
I think it's a gift too. I agree. I think $14.50 is a gift this morning.
On GameStop. Speaking of takeover or M&A, what about that Ford tender offer yesterday? Did you see that?
So what was that? No, I did not.
Ford received a below market mini tender offer by Baker Mills at $7 a share.
That's just silly.
I mean, they rejected it, obviously, but I thought that was interesting. You don't see that too often.
Yeah, that's just silly. I don't know what the intent of that is. Obviously, no shareholder is going to take $7 and $7.90. I did see a headline go by, but I didn't click the story. So,
you know what?
I don't know if somebody's short it, just trying to make everybody scared. The Ford's going. I'm not a fan of Ford. We know I sold all my stock last year. I was in it for a long time. I don't know where I sold it. I sold it for the tax loss, I think in the 8s or 9s, but so a little bit higher than what it is now. But I took heat on it. I bought the thing at 13 when I thought, Ford was making a comeback. They were doing great sales and stuff, and I was wrong. And sometimes you got to admit you're wrong. And I don't, I'm not buying the Ford story. Yes, it has 7.59% dividend. Yeah, if you want to take a shot at $7.50, I'd stop out near the recent lows. It is a dog's market a little bit here right now. We've seen GE hold up very well yesterday. So, some of the dogs are barking right now, and that's typical for January. Call it the January effect. Obviously you had a lot of selling in December, tax losses, and now you don't have that. So a lot of times you see the dogs bounce back. So from a trading perspective, I don't mind Ford here, but from an investing perspective, I still don't like it.
Yeah, and the tender offer was to buy 400,000 shares, but you don't see tender offers in major names like this too often. So I just thought that was interesting.
And you know what else? Spinner just made a point. This is exactly what I thought too. I didn't speak of a funny. Spinner read my mind on this. He says maybe this company was short the thing and they wanted to cover it. So maybe they just want to they drive it down. They're scared. Oh yeah, we'll give you 7 for it. I was talking about. I don't know what the story is on it. But that's that's what I initially thought. I was like, maybe these guys just want to get the price lower somehow. So they throw a low ball offer to scare some people. I'm not sure what the intent of that is, but anyways, we can't speculate on that. But in any regard here, $7 takeout and stocks at $7.90 is just silly.
All right, let's go to the airlines here. Not a great day for Delta Airlines. They had their worst day. Let me see here. Wow. Delta had their worst day in 7 years yesterday. That was on the heels of some bad PRASM guidance. That's passenger revenue per available seat mile. That came in lower than expectations. Delta, they all got hit. Delta got hit the hardest. Obviously, it was their number. We'll talk about. We'll work through the sector here, but we'll start with Delta.
It just hit hard, down $5 yesterday, basically. So hit really hard on their warning. All the other airlines took some heat as well. LUV, which has been in the doghouse. Save has been one that's held up better, but it got hit hard yesterday too. So now that gets interesting. It needs to hold the low from the 24th, which was 53.55. Otherwise, it's going to be at $50. They're in a decent environment because gas, obviously oil is still in the gutter, even though we've had a rally the last few days. But that being said, they've come down a long ways too. So UAL down $80. It's interesting, the separation. You see some of these airlines have done fairly well, and other ones have not done good at all. You look at the Delta chart, the monthly, and this thing is making, if we go out to the weeklies even, this thing's, making, new lows for the last new 52-week lows here. Where if you look at something like SAVE, SAVE, That stock is up almost 60% in the last 52 weeks.
And what about?
So it's interesting the separation here because they're not all moving. They tend to move together on a day trading basis. But overall, there's definitely some drift here. And there's some stocks that are outperforming the sector and stocks that are underperforming the sector. LUV has been another huge underperformer. You're talking about a stock that is approaching lows from, like I know we just had recent lows, but we're getting back to the middle of 2016. So some of these airline stock charts are really getting hit.
But what about, speaking of all of them trading similarly on a day trading perspective, JetBlue yesterday gained most of it back.
I'm looking at the JetBlue chart, bringing it up here. What are you talking about, Spencer? I'm sorry.
It gained most of its losses back yesterday. Not entirely, but
Losses from what? I'm confused because I look at this thing trade down near the lows as well. Are you looking at an intraday chart?
Yes. That's what I'm saying.
Okay, I don't even look at the intraday charts.
Okay.
So, and this is a good technical, when I'm looking at a stock for the first time, the first chart I'm always going to look at is the 90-day. Okay. I want to get a feel for where the stock has been, and that gives me a little more feel for maybe potentially where it's going. I look at a 2-day chart, meaningless, absolutely meaningless. I'll tell you how many times the only time I bring up an intraday chart is when I'm trading something. I kind of want to know what it did yesterday, just because I want to know, well, you kind of want to know what it did yesterday, but the most important chart when you're looking, especially from a swing trading perspective, bring up the 90-day. Get a feel, because when I look at the 90-day on this, I see a stock in a heavy downtrend. I see a stock that got killed in December. I don't see any comeback at all, really. So, it's a different perspective. But yeah, if you go to a 2-day chart, it got hit and then it came all the way back up there. But, you're talking down 50 cents, up 50 cents. So yeah, I had a good rally from yesterday, but from the lows of yesterday after getting killed. But stock chart still looks ugly on a 90-day.
Right,
so I'm a big fan of the 90-day. That's what I lean on when I'm even looking at day trades. You want to get a feel for, is the stock trending up or trending down or trending sideways? And that's going to give you a better feel for, maybe what it's doing, because the trend is your friend. What's done for the last 90 days, it has a tendency to do the next day as well. Not always, but as traders, we live in the law. We don't live in the absolutes. We live in the law of averages. And, if this stock is trending down, it typically is going to be weak relative to the market. If it's trending up, it's probably going to be strong relative to the market until those trends break.
Right. And a lot of, as someone's pointing out here, a lot of it has to do with the price of oil as well.
Yeah, for sure. I mean, a lot of the airline stocks, you would think, if oil went from $75 to $45, it's got to be pretty good for airlines. And most of these airline stocks went down during that time. So, some people saying, oh, well, they can pass it on to customers, that it's not that big a deal or whatever. But I've always went, going back to my economics courses and talking, I always thought lower oil was good for airlines. In this case, it really hasn't been. But again, we've been in such a bear market, they've just been hitting everything.
All right, moving on. Other news in the morning. We've got about 7 minutes till our jobs number, so we'll cover that in a few. But I want to get to ATVI first. Activision Blizzard has now lost 2 CFOs in the last 2 days. One was for Activision Blizzard. The other was for a subsidiary, just Blizzard. One of those CFOs has gone to Square. Remember, they got punished a lot on October 10th when their CFO abruptly left. So they get theirs now. But Activision Blizzard now trading at the lows on daily here. They have now lost 2 CFOs in 2 days.
Popped on this news overnight. Yeah, it was a nice lift for it. But really, when you start thinking and you put it in perspective here, Square, it's nothing more than a dead cat bounce. The stock has been one of the worst performers, losing half of its value since October. Valuation was this was a value trading. Anything with a high multiple really got killed. So is Square still a good story? Sure it is. Is there a value here somewhere? Yeah. I don't know if it's at 52 though. The 50 is the one you're leaning on now. So if you're bullish this and you're saying Square is going to come back eventually, I would stop up below the 49.82 low. That was from the 24th. Again, a lot of stocks made the lows on the 24th there. That's where I would stop out. So leaning on the 50. You're chasing this up $1.50 on a new CFO. I'm telling you, this is not the market to chase stocks, and we've seen this again and again and again. We've been saying it for months here now. It seems like when you're buying stocks and chasing them up there, maybe it works for a day trade, but it seems like a couple of days later, something bad news comes out, either it's Apple or something, or the market just kills and rolls over, and it gives you another chance. So it seems like the stock market gives you a chance again and again and again to buy near the lows. And why does it do that? Because it keeps making newer lows and lower lows. So just be cautious if you're coming here and saying, okay, yeah, Square's turning around now. This is it. If you're putting it on and you've got an out, like I always say, you can put any trade on as long as you have your out defined. I would have my out if I was on this thing at 49.82. I'm not going in here because right now it's been a difficult market to be calling the bottom in, and I'm not going to say, could 50 be the bottom? Sure it could, but it doesn't have to be. And there's still I think there's still some pain ahead here. When I look at that S&P charts, I don't see anything really that exciting. We did not shrug off the Apple news yesterday. Yes, we get a little spike. Maybe it's because, thinking we're going to get some deal done with China, but, and maybe we do. But I still think there's a lot of things this market is worried about. And that's why I'm not coming here and loading up on Square.
And what about ATVI here? I mean, this one's been punished.
I own ATVI. Multiple is more attractive. I still believe in the esports story. I still believe in gaming. This is in my long-term retirement account. I put it in there at 50. I've obviously been wrong. The stock's at 45 now. I could have got it cheaper, but it was on my watch list for a long time. I've got a little bit of EA as well. I want to buy more of these esports stocks because I really believe in the long term of esports. I also believe in the long term of gaming. I don't think gaming is going away. These stocks, are giving you multiples, market multiples at 17, 18, 19 times. And I think, we had Packer on the show and thinks it's a double in 2 years. I don't know if it's a double in 2 years, but I like it from a long-term perspective. Short-term trend is still not your friend. Yeah, ATVI is getting a lift. And often you see when GameStop gets a lift, it's amazing. I don't know why. Because we saw this when GameStop got hit on their earnings. You see the video game stocks get hit. I don't know if there's that much correlation with GameStop anymore, but there's still, what we call algorithms or whatever that still trade it with it. So GameStop's getting a lift to this point. I wouldn't be surprised to see some relative strength in ATVI and EA just because GameStop's getting a lift.
Real correlation and implied correlation, I think, are two different things. Yeah, maybe in reality they're not that correlated, but as far as the perception is that they are correlated. Yeah. So what difference does it make, really? Not really any. When are you gonna retire?
I'm gonna leave right now. I gotta go trade the jobs number. Okay. We're gonna bring Brentster on. He's gonna talk jobs. You can talk Spencer.
Good luck, Dennis.
Talk for a few minutes. Brentster, I'm gonna give you the mic here for a few minutes here. I'm gonna go trade for a few minutes. I will be back.
All right. Hey, Brent, how's it going, man?
I'm doing well. Thanks for asking, Spence. How about you, buddy?
Doing all right. Just trying to get through the week here. What do you got for us on this jobs number?
All right. So for non-farm numbers, we are looking for a reading of 177,000 jobs added. A reminder, the November reading was for 155,000 jobs added. For the private sector number, we're looking for 175,000 jobs added. The unemployment rate, another very important part about this data, is expected to be unchanged at 3.7%. We have about 70 seconds here before the number. It's going to be out at 8:30 a.m. Eastern time.
And there was some confusion because I didn't even think this number was going to come out today. I thought because of the shutdown.
Yeah, for sure. Between the holiday and the shutdown stuff, the econ data schedule has been a little funky, to say the least. We've been having to check our economic calendar each morning, basically, to make sure the agencies haven't updated their time or anything.
And this is within the context of yesterday's ADP report, the biggest job gain in 2 years.
Exactly.
Does that, we're a few seconds away here from this report now. Does that color anything? I mean, there are obviously two different methodologies, two different reports.
A lot of economists I have spoken with in the last, couple years really like to use the ADP number to get some insight into the upcoming jobs report. And they're always out in the same week. And if you want, you can always even use the weekly jobless claims number, which is on Thursday. So it goes ADP usually Wednesday, jobless claims Thursday. We get the jobs report Friday. And this is coming up in about 6 seconds here. I'm going to read them off to everybody as we get the numbers. We were looking for, so the non-farm number coming in here at, 312,000 jobs added on the non-farm sector. Once again, the expectation was for 178,000 jobs added. For the private sector, we have 301,000 jobs added. These are huge beats here, ladies and gentlemen. The unemployment rate unemployment rate up 0.2%, 3.9%. That is going to be something that is going to temper the good news out of those jobs added numbers. And what do we have here? We have a reaction in S&P.
Yeah, you're seeing that exact thing. You saw the pop.
There you go.
I think
exactly.
with the initial number, what was it, 3
reading, It was 312 for non-farm, 301 for private sector. So traders read those numbers, they go, yes, really good news, and then they see that the unemployment rate has gone up 3.9% to 3.9%. That's up about 20 basis points there from 3.7% expectation. That's what it was last month also.
Yep.
But we do know that the unemployment rate itself is subject to a little bit of like manipulation by the agencies and stuff. Whether the labor market is growing has an impact on the unemployment rate. So it is a very important part of this number, but there are other factors in there. I mean, just like there are for the non-farm sector, the private sector, the manufacturing, the government, all those sectors, they can be, subject to one-time gains for government jobs, one-time gains for manufacturing jobs, etc.
Sure. And we are seeing, so the S&P futures did pop and drop on that news. We are off the lows of that move. Didn't quite get back all the morning's overnight gains, but we did hit a low of, what is that? About 24.70 there for a moment. There we're back around 24.75. The S&P futures looking at the banks a little bit. Bank of America popped, giving back some of those gains already. JP Morgan, same thing, although we're trading at the high of the pre-market session here at 98.62. Goldman Sachs, nothing really. Can't pull my chart here, Goldman Sachs, so can't look at that right now. But yeah, Goldman Sachs up on that news. Banks popped. Interesting.
Banks
Goldman
popped.
Yep. Yeah, they're
almost $3.
Yeah, they're at 172. Yep, they're 172.50 right now. Usually, Joel and Dennis like to look at the banks first, as well as the TLT to see how they move in the corner, of course, with the S&P futures. So those are sort of the biggest instruments that usually react most if you've been listening to our show for the past few reports or anytime. You know that those are the instruments we usually look at here. So jobs
and just to be a basic idea, this isn't anything advanced, but I always like to just pull up the XLF. That's the financial select sector spider ETF.
Right.
Just gives you a broad swath of the
financials. And that does not have as much a pre-market as the individual stocks do.
Good point. Yeah, absolutely good point. Volume really light.
Not as much liquidity is going to be there. So looking at this number here, I don't really know what to make of it.
You know what I should do? There was some revisions. Let me find the revisions real quick.
For the last month's reading.
Yeah, for the last month. Those are always important.
So again, just to recap that number here, the non-farm payroll is 312,000 versus 184 estimate in the non-farm. That's a huge beat. Private payroll is 301,000 versus 175, another big beat. But unemployment ticking up 3.9% versus 3.7% estimate, and that was also the prior reading. So a tick up in unemployment month over month, and that comes despite huge beats in job gains in the private and non-farm payroll sectors. Wow.
We did have so when we get these jobs reports on these first Fridays of the month, the agency will revise the numbers for not just last month, but also for the 2 months before.
Right. Okay.
And so for non-farm, we had a revision for both November and October higher, and rather sharply higher. The non-farm number for November was revised from 155,000 when we first got that report to 176,000. The October number was revised from about 237,000 initially all the way up to 274,000 for October. The private sector number also revised higher for November from 161,000 when we first got the data to 173,000. So, just from looking at the headlines here, it looks like the labor market is doing just fine.
All right. And Dennis is very knee-deep in trades right now. So thanks a lot, Brent. I'm going to take us on a quick break, and I'm going to grab our guest for the day, John Inch, Senior Analyst at Gordon Haskett. We'll be right back in a moment. All right, welcome back, everyone. As promised, here is John Inch, senior analyst at Gordon Haskett. John, how's it going this morning?
Happy New Year to everybody. Thanks, Spencer, for having me. Appreciate it.
Happy New Year to you as well. Hope you had a relaxing holiday. All right, I've been reading some of your notes recently, John, on General Electric, so we'll start there. Actually, before you even get to what you say in your notes, I was half joking a few weeks ago on our show when I suggested the 666 bottom. But is that the bottom here for GE, 666?
Well, it's really a binomial outcome. It certainly appears to be a trading bottom at this juncture, but much of this really rests on the outlook. Remember, we don't even know what the guidance is going to look like, what the company's strategic plans are.
Right.
What we do know is that they are gearing up to do a massive IPO of their healthcare business, something that they're being forced to do, something they really don't want to do because it's one of the few cash generators in the portfolio. And cash is nothing's really changed. Cash is a real problem for this company. So if, today we've got obviously the calendar rolled over and there was a fresh round of upgrades and analysts, of course, and Wall Street, it's a giant machine pushing this big IPO. So, Wall Street wants, because of the fees, the IPO to succeed. If, however, this IPO were to stumble, you're talking a very large deal in the face of very choppy markets and a global economic slowing. In my opinion, it's kind of really do or die. If it doesn't succeed, the company could not only retest that 666 low, but plunge a lot further than that. I think there'd be a risk of debt rating downgrades to junk, and then you're talking the risk of insolvency.
So that's actually what I wanted to get to next is, in your view, how badly does GE need to raise money?
This is really, I've called it the last bullet, and it's critical for the survival of the company. And I'm not suggesting that they won't be able to do it with respect to the IPO. Let's take a step back. They are selling everything that is not nailed down right now. They've abandoned their digital strategy, which they spent billions of dollars creating over the years with much hype and fanfare. Selling off those businesses, moving the rest of the operations into kind of this sort of shell of its former self. They're selling obviously Baker Hughes at all-time lows. You see the price of oil has collapsed, and Baker is literally at all-time share price lows. Yet GE is a forced seller. This asset that was once worth a significant chunk of money continues to dwindle. They're not doing these things because they think it's an interesting thought exercise. They're doing it because they clearly need money. They're deathly afraid of further ratings downgrades. They're running a giant financial services company with bank debt, which is not a sustainable model. And I think the clock is ticking. As I say, the IPO of healthcare will buy them time, but it's not entirely clear to me that it's going to be as successful as everyone simply presumes, or as these investment banks in Wall Street, I'm sure, are advising GE. There'll be absolutely no problem in getting this thing done. You're talking about a very big deal. Markets are choppy. You've got other IPOs likely to come out, this early this year, including Lyft and Uber. And it's just not entirely clear that there is going to be the kind of appetite that for this deal that GE aspires to. So no, it's the thing remains very serious. And it seems that a lot of the short-term money seems to be simply looking past the $100+ billion of net liabilities and all of the other issues that that are really challenging the company. Kind of looking for that trade, and I understand that, right? Strategically, I think the company remains in deep difficulty. It's going to take a very long time to work it out. And as I say, the IPO of healthcare is really the last bullet. Once this is done, there's really nothing else they have up their sleeve. They have to get this done. It's critical. One more thing I'll add. Once the IPO is done, so let's presume that they full bore IPO half of the entire healthcare business. You're not actually going to get claim to the rest of the cash flow in the half that you still own. It's going to be exactly like Baker Hughes. The cash that's going to come to them will only come in the form of a dividend because healthcare is being created as a separate independent company, separate management board of directors, and the like. So they better hope this thing goes well and they get enough of their liability and pension liability moved onto that healthcare business when, by the way, it's going to be a business saddled with a lot of pension and debt. It's not entirely clear to me that this is actually going to trade at a relatively robust valuation, the way, of course, all of these bulls continue to just presume that it's going to be a premier asset that trades at the top of its range. I'm not convinced that's true.
Any insight as to timing or pricing of said IPO?
Well, it'll probably be the spring. I would say, just from an overall perspective, as soon as possible, of course.
Okay.
Unless the market, continues to do what it's doing and they just can't get it done. That will determine the size and I think the trajectory. They filed, it was revealed, I believe it was Bloomberg or Reuters announced that they had filed a confidentiality filing with the SEC. That's a little unusual. It's really, I think, just meant to get into the market the fact that they are going to do this IPO. They're probably not going to follow the same playbook that John Flannery, the former CEO, followed, which was a 20% IPO followed by 80% spin to shareholders, right? The markets really didn't like that plan. The markets, in this case, which encompass the credit markets, want GE to retain this business, which is a good cash generator, to be able to continue to sell off or monetize, over time to be able to pay down credit liability. There's no question that, the IPO of healthcare and the sale of healthcare up to, frankly, almost all of healthcare to pay down debt and liability is a clear transference of wealth from shareholders to credit holders. Now, that may be, important in the short term to stabilize the company and prevent a continued run on the bank, so to speak. But it actually destroys shareholder value over time. So even though you get lulled into this sense that, things are stabilizing and improving because they're raising all this money, but shareholders already own this business. In fact, what you're doing is taking it away from shareholders to pay credit holders and pension, which go to employees. It's a clear shift of wealth from the equity side to the debt side, which buys you some time, and it certainly gives you a little bit of stability, but it doesn't actually do anything for GE as an investment in the long run.
You noted that Larry Culp had sort of walked back some comments he had previously made. He'd walked them back in November from November from comments he had made in October about the need to raise capital. We know they have their earnings report at the end of the month here. So what do you expect him to say?
So what's curious about this earnings report at the end of the month, first, it's a week late from when they traditionally report their earnings in the third week. It's at the very end of the month. And there's also, there doesn't seem to be any sort of follow-up bigger analyst meeting that's been scheduled. Now, we may hear more about that, but let's put it this way. In an hour earnings call, where the company takes up 45 minutes to present its results and only 15 minutes of Q&A, there's no possible way you can go through all of GE's issues that can satisfy investors. So the company needs to hold an analyst meeting which I would think is at least a half-day event to go through all of these issues. Now, are they prepared to do that? I wouldn't think so. And all of this is sort of compounded by, in terms of the trickiness of the timing, by the fact that they are still under accounting investigation and by the SEC under criminal investigation by the DOJ. Their auditor, it's highly likely they kick out their auditor, their longtime auditor, KPMG, which charges absolutely just egregious sums to audit General Electric versus other big industrial companies, right? So I would say that, certainly they're going to present their earnings. The earnings are not going to be great. I mean, they haven't been able to provide guidance, so we know that. They're going to have to say something about 2019. And I will say this, that Larry Culp truly is a stand-up person, right? That's not to say that the company, in terms of the roll-up of the forecast, can't at a division level be too aggressive, which GE habitually is, right? They're traditionally too aggressive with their numbers that have to be continued to be walked back. But I think the numbers that you're going to see for the 2019 guidance, which is a year of, this is not a steady state year by any means. It's going to be a lot of moving parts. I think these numbers, though, are going to be Culp's attempt to at least set a base. And on that score, investors could, in fact, be shocked to the downside with how low things actually transcend. Plus, remember, all of this is happening against the backdrop of a deteriorating global economy, of which GE is a giant global corporation. China, Europe, these are very important markets to GE. Both of those economies are deteriorating. The ISM just came out. It's clear that the U.S., given auto pressures and now the price of oil, that's going to pressure downward the industrial economy. And then GE still has a mountain of debt. It's going to be very tricky. This is going to be a heavily scrutinized end of month, release. But there's no possible way they can cover all of the issues. They're going to have to do that at a follow-up date, and it's really just unclear when that's going to be, or when they'll be ready to actually do it.
And so just to wrap up this GE discussion, you've still got the underperform and $10 price target?
Yeah, and firstly, just to put this into a context, we at Gordon Haskett, we don't make trading calls. We're trying to serve a broad swath of institutional investors, and so the price target is, it's directional. We haven't had any kind of update from the company. Really, everyone's been operating in a bit of a vacuum. I'm on record as saying that on a cash basis, GE could easily trade to $5 per share. That doesn't appear to be the likely prospect, but I think relative to certainly other industrial company opportunities, which is my coverage universe, certainly over the next couple of years, I do not see how this stock can outperform. Can it trade higher? Sure it can. Can it trade lower? Sure it can. Is $10 set in stone? Well, we need to get a lot more information. Remember, $10 was set when the stock prices was considerably higher. But I do think some sort of a range between $5 and $10 is, relatively speaking, that's the way I think everyone should actually think about it.
All right, let's talk about something a little happier now. You mentioned you do cover the multi-industrials. Let's talk about Rockwell, ROK. You've got a buy rating on them. Outline your thesis there.
Sure. Now, Rockwell, it is a pure play on factory automation. And globally, factory automation is in very robust demand, and it's going to continue to be so. As cost pressures across the world, including in China, continue to ratchet higher, companies are looking for productivity solutions, which invariably mean driving a substitution of people for machines. So everything that you see around you in life, right, there are fewer checkout cashiers, there's fewer toll takers. This is happening at an advanced level on the factory floor. In fact, the factory of the future, we're just going to be able to visit, and likely they'll have to turn on the lights because there won't be any workers. Rockwell is the largest provider of factory automation systems and solutions in the United States and Canada. It's number 2 globally behind Siemens. And it's really in a sweet spot, I think, of where demand for these products is going to head over time. Now, that said, Rockwell is also cyclical. The stock is not, is obviously not on its highs. It's come off a lot. And part of it really is a function of the fact that in a global downturn or any kind of economic downside scenario, what you end up happening is your customers tend to not want to spend on automation equipment as quickly because automation equipment expands your capacity. And if demand dries up, you don't really need to expand your capacity. If anything, you need to figure out how to shrink your capacity. So from a strategic basis, there's no question Rockwell is going to hit higher highs. And I think it's pretty close to where it's going to ultimately bottom. I don't expect this downturn, certainly with respect to North America, to be all that deep. It could be protracted, but on that score, Rockwell is actually doing a lot of things to shore up their position, recapture market share. They have a new alliance with PTC, the industrial software company that appears. Not only is it it's in early innings, but it does appear that it's got a long runway ahead of itself in terms of the contributive benefit. And so, yeah, we're definitely out of consensus on Rockwell, but it's not for the faint of heart. I just want to be clear, right? My entire industrial universe is cyclical. So there's nothing that's going to be immune from a recession. That's just not the group that we cover. But again, a lot of this has already been priced into many of these stocks already. So at these levels, there may be $5 or $10 of downside for Rockwell, but you could be staring in the face over the next couple of years of over $200 per share. And I think that's pretty good risk return.
It seemed like of your coverage universe, the name that where you most highlighted China pressures was Emerson. They are the most exposed to China. Is that the case, EMR?
They are. Multi-industry, say in contrast to the tech companies, doesn't have as much relative direct exposure to China, but China is the world's largest manufacturing economy. As a source of relative growth, it is pivotal and critical to the equation. So as you've seen, of course, China's economy, and we all know we can't really believe the Chinese statistics at face value. So if they say their economy is growing at 6%, it's probably growing at 3%, which in Chinese terms is very, very slow. In Emerson's case, they have two businesses. They make process industry, which are industries like the oil and gas industry, the chemical industry, and so forth. They make control systems and field devices, which are valves and transmitters and other things that make these big plants run. They are the largest player in this business globally, and collectively Emerson has about 10% of its revenue coming directly from China, but there are spillover effects and indirect effects from that market that really just would create for an Asian theater that's critical to Emerson. The other piece of Emerson, almost half of the company, is an air conditioning business, and it's both a residential and commercial air conditioning business. These businesses in economic difficulty, right, or economic slowing, people don't need to, and companies don't need to upgrade or replace their air conditioning systems as quickly. They simply can defer them or maintain them longer, buy more spare parts, et cetera. And so, there's no question that Emerson is on the front line of China slowing. It's not an electronics company, right, that doesn't do that. So Apple's challenges are not Emerson's challenges. It's more broad than that. But look, at the end of the day, Emerson ultimately will trade. If you look at its stock chart and you can map it against the price of oil, it looks like the price of oil. That's the critical input driver. The price of oil has collapsed, and it's not really clear what's going to cause the price of oil to regain a footing anytime soon, particularly given the U.S.'s position as the world's largest oil exporter and technology that's driving so much extra supply coming out of fracking wells. OPEC can cut back production all they want, but the fact is the U.S. and Canada really sort of drive the bus here. Russia and Saudi kind of secondarily, and the global economy is waning, right? And the Chinese themselves are looking for substantial ways to reduce pollution, electric vehicles and the like, and that's going to put long-term downward pressure on demand for crude. There's no question this is true. So, I think Emerson's in a bit of a pickle at the moment. Their orders right now are fine, but that's what all these companies are going to be telling you. These companies, just to be clear, when you talk to them, they're not going to tell you what's forward-looking. They're going to tell you what they're currently seeing, and they typically are not good lead indicators for how their business financials are about to play out. They typically are the last ones to know and the last ones to communicate. So you got to be looking at other things, not listening to what the companies are saying or how robust, quote unquote, they say their business activity is.
All right. Well, John, you've got some fans in the chat. Someone's asking if you have Twitter. I don't think you do, but are you on Twitter by chance?
I don't use it. Social media is one of those things, unfortunately, that it makes it tricky for analysts because our opinions tend to carry legal weight and implications. And I've just shied away from social media because I don't want to get caught in the possible risk of expressing what someone may interpret as an opinion that hasn't previously been published. So,
if you ever
really the best way is just to email me a question and I can send you a response.
If you ever, do you want to share your email right now, or do I can?
Sure. It's jinch at gordonhaskett.com.
There we go. All right. You got some fans in our chat. John G. Inch, thanks so much for the time as always. And it's already Friday, so have a good weekend.
Thank you very much. Great chatting with everyone, and Happy New Year again. Take care.
All right. Dennis, are you still alive, man?
Oh, yeah, I'm still here. I'm trying to survive here. Okay. Wild swings. So we got hit, came all the way back up, actually made, new high since 8 o'clock as we've been on the show. So wild 10-point drop, came all the way back. Banks caught a bid, like Brentster was saying, right off the hop. So they started getting bid. And not surprising, you see the TLT is trading down significantly. So that is good for banks. I would expect relative strength there, at least for this morning, as long as the TLT remains weak and the market remains strong. Overall here, let's give you a little imbalanced look.
Oh, I forgot all about those.
What's that?
I forgot all about
Square.
that.
Let's go to Square. 57,000 to buy. We know the new CFO is the driver there. General Electric, 418,000 to buy. That's, usually that seems to have a sound balance way. Not the case this morning here. We've got Berkshire Hathaway, 37,000 to buy. Berk got the beats yesterday because of their huge Apple position, so they were relatively weak. You know what? They're fairly small here again, though. I don't really see anything like, whoa, you got to check this one out. So fairly small, the imbalances here. But I would expect, keep an eye. Financials probably to be relatively strong with the TLT this week.
All right, so we got the pop from the jobs number. How does that change your approach to today?
I don't know if it does. I mean, we're right in the same spot. Like I said, I just lean a little bit more to the financials being strong because obviously the TLT is weak, and that's your best indicator. I mean, you can try to sit there and interpret the jobs number all you want. The TLT will interpret it for you. So with TLT trading weaker here, that's going to be a little bit of pressure on the utilities. Although everything's a stock right now, so they're moving together to a certain extent. So normally on these days, you see the XLU get hit pretty hard with the TLT down. Not sure it's going to be the case, but it's not going to be as relatively strong as other things. And so that's what I adjust with. It's one of the key things I look at. The two things I look at on my screen all the time: TLT and the SPY. And I'm looking, obviously, what the market's overall doing and what is the TLT doing, because that gives me an indicator what the bonds are doing.
All right. Let's just as we wrap the show, let's go to some ratings here. I guess I guess Goldman Sachs had their analysts on vacation because they're all back this morning with a ton of commentary. First off, not a rating, but they just outlined their best risk-reward stocks in the internet space. They highlighted Amazon, Alphabet, PayPal, Grubhub, and Netflix as their best plays, and Spotify and Twitter as stocks with most upside from their current levels. But as far as ratings are concerned, Goldman is upgrading Virtue Financial, which we know you like, Dennis, to a buy, upgrading SIBO to, they're upgrading a bunch of stocks to buy. I'm not going to read them all off, but SIBO, Carlyle, Fortinet, called a downgrade, Sojin, of course, upgrade, Expedia, called an upgrade, to buy, Etsy upgrade to buy, eBay upgrade to neutral, eBay downgrade to neutral, and Snap downgrade to neutral. So a lot to digest there.
Yeah, so tons from Goldman here this morning. We could just go to the Etsy first. They're giving that a buy rating here. It's up 4% in the pre-market. So Goldman, obviously, this is a stock that has been under pressure as of late, at least in the last couple of weeks, but held up better than some of the others. We're not even close to the lows we hit on the 24th, and we're not even close to the lows that we hit in October. So Etsy has come back a lot better than some of the other ones. Still a growth story here, still a story here. So, I wouldn't say this is one that I'd necessarily be selling the rip on it, because there is a good story here. Just keep in mind there's a couple tops there. 48.58 was the high just from the 31st. That's going to be your first hurdle. Kind of get over there. It's a big pop here this morning, a 4% pop on that Goldman upgrade. And then Virtue Financial, this is the largest position in my investment portfolio. This has been there for a while, and obviously I like it because of the volatility play. I've talked about the show multiple times, saying I believe it's a hedge against the overall market. The only wild card is if the market really start getting weak and they start talking HFT regulation. That's not good for them. That's why you see the big down day that Virtue Financial had back on the 18th, because there was comments there about further regulation on HFT, and that's obviously Virtue Financial, one of your biggest HFT firms, and that's not good for them, but they bounced right back. I think Virtue Financial must be killing it right now with this volatility. So, and I think Goldman's thinking the same thing, and that's why they upgraded this morning. It's trading up 60 cents, still like Virtue Financial, still sticking with it on a long-term portfolio.
Other upgrades to note: Bank of America upgrading Intel to buy, Guggenheim upgrading Regeneron to buy, and KeyBank upgrading Shutterfly to overweight, so they're equivalent of a buy there. As far as other downgrades are concerned, Emerson, which we just discussed with John Inch, downgraded RBC to their version of neutral. RBC also downgrading UTX to neutral. And that was, Texas Instruments, TXN, downgraded Bank of America to neutral as well. So a lot to digest in terms of ratings here. This morning, 8:59, Dennis, any final thoughts as we head into the final
Expect volatility. It's the only thing we can promise you here. It's going to be choppy. It's going to be wild. I don't like chasing. If you think, you get the bottom, I think you get another chance here again. So I'm not chasing the rally here today. I think it's more of a dead cat bounce. Okay. I do believe, there's a catalyst here. I think we're going to get a trade deal. So you got to be cautious if you're shorting here now, because if you get that trade deal overnight, we could be up 600-700 points in a heartbeat. So just be careful if you're short. I'd say be careful if you're long. Just be careful in this market. So don't let stuff get away from you.
All right. If that happens, we'll be sure to discuss it on Monday's show. Thanks to everyone for listening. Thanks to everyone in our YouTube and premarket.benzinga.com chats. Thanks to John Inch. Please remember that all the information on our show is for informational purposes only and not meant to be investing advice. Hope everyone has a good weekend, and I hope you join us again on Monday. Joel will be back.